Dexter, let's talk about capital cost allowance.
Yo, UNS man, it's 6 o'clock in the
No,
morning.
this is the most important part.
Okay, let's do it! Time to open the CCA toolbox and look at the most common classes you'll use and a powerful strategy called elections. Let's get familiar with your options. Meet Class 8, sort of your miscellaneous or catch-all toolbox. One of the most important, yet often misunderstood, parts of Canadian business taxes. Capital Cost Allowance, also known as CCAs. Sounds complicated, but let's break it down into English. What is a CCA? Think of it as the tax system's way of letting you gradually recover the cost of a big ticket item, like a machine, a truck, or even a building. You can't deduct the whole cost in 1 year because that asset will help you make money for years to come. So, what a CCA does is it lets you match the expense of the asset to the actual income overall as it generates over its life. This is the official replacement for accounting depreciation when you're dealing with the Canada Revenue Agency. Why do we even need this? Well, imagine a problem. Without the CCA, if you bought a delivery van, you couldn't even write it off until you sold it at a loss years later. It's like a huge timing mismatch. You have all the income from using it, but no deduction for its cost until much later. As a result, the CCA solves this by fairly spreading the cost for the van's useful life. Here's the multi-million-dollar question. Is your expense capital expenditure or a current expense? This is actually crucial. Capital expenditure creates an enduring benefit and gets added to the asset's overall cost, which you then claim CCA on it over time. A current expense is for day-to-day operations and is fully deductible right in the year that you actually pay for it. So the real question is how do you actually tell the difference? The CRA gives us some handy clues, or capital expenditure indicators. Let's run through them now. The first component is the enduring benefit test. Did the expense create an asset or an advantage for your business that will last a long time? If yes, it's likely capital. Oh, wow, so beautiful. Oh, or the betterment versus maintenance. This is actually a really big one. Are you making a genuine repair or are you making it better? Replacing rickety wooden steps with new permanent concrete staircase is actually a betterment. That's capital. Just fixing a broken handrail on the wooden steps is maintenance, which can be considered a current expense. Separate asset versus an integral part. By replacing a whole separate asset, like swapping out an old lathe for a brand new one, capital. If you're just replacing an integral part of a bigger asset, like a ship's rudder, that's usually considered a current expense. A relative check. What does the replacement part actually cost compared to the value of the whole property? If you replaced a $50 keyboard on your $2,000 computer, that's likely a current expense. If you replace the $15,000 engine on your $20,000 truck, that starts to look a little bit more like a capital cost.
Mikey, no, Mike, that was so not right.
Ready for use. If you buy a used property and have to spend money to actually make it suitable for your use, it's like retrofitting a used van for deliveries. Those costs are actually capital. The anticipation of the sale rule. If you make repairs right before you sell a property, specifically to make it more sellable, Canada Revenue Agency generally considers that to be a capital expense. And there you have it, the CCA in a nutshell. It's all about timing, correctly categorizing your actual expenses. Get this right, and you'll have the path to a much smoother tax filing overall.
Now that we know what CCA is, let's figure out what it applies to and learn some key terms. This is the eligibility and key definitions section. So to claim CCA on something, it has to qualify as a depreciable property. Think of it as a really selective club with 3 rules for entry. Rule number 1, you gotta own it or lease it. The property must be owned by you, the taxpayer, or you can have what's called a leasehold interest. Basically, you need to have a substantial stake in it. Number 2, it's in the club directory. The property has to be listed in a prescribed class in the official tax regulations. Things like cars, computers, and equipment all have their own specific classes. Rule number 3, it's available for use. This is a key timing rule. The asset has to be ready and available to use in your business. You can't just buy a machine and leave it in the crate in the back room and start claiming CCA. It has to be good to go. Now, just as important is knowing what does not count as depreciable property. These are the things you can claim CCA on. So, number one, land. You can't depreciate the dirt. The land itself never wears out. Number two, the inventory. That's what you're selling, not what you're using to run the business. Number three, personal/hobby property. If you didn't acquire it to produce income, it's out. And number four, things you already deducted. If the cost was already claimed as a current expense, you can double claim it. All right, you bought a qualifying asset. What exactly goes into its capital cost? It's not just the price tag. The capital cost is the full cost of getting that asset ready to make you money. This includes the obvious one, which is the purchase price, the extra fees, such as legal, accounting, and engineering fees, the setup costs, delivery, installation, and testing costs, and if you built it yourself, the cost of materials, labor, and overhead. All of this gets added together to form your starting capital cost for CCA. And now, for the second most important concept, the underappreciated capital cost, or UCC. This is the magic number. So think of the UCC as a pool of money for each class assets. So when you add capital cost for a new asset, you buy into the pool and you add the water. But it drains a bit each year when you claim CCA, which is a percentage of the pool's balance at year end. This is your deduction. So when money flows out, it's when you sell an asset. You take the net proceeds of the sale of the pool. So the UCC is simply all the capital costs you've ever put in, minus all the CCA you ever claimed, and minus the money you got back from selling stuff. Your CCA each year is calculated as a percentage of this ever-changing UCC pool.
Now, we're going to talk the actual rules of the game, the CCA mechanics. We've got our assets, we know our definitions. Now let's learn how to actually play the game of claiming CCA. Welcome to the mechanics and the rules. First up, the actual classes. Tax regulations sort every depreciable property into specific teams or classes. Each class has its own maximum CCA rate. So your car is in one class, class 10. Your computer in another, class 50. And each has a different percentage you can claim each year.
Next is the calculation method. CCA isn't a straight line. It's usually calculated on a declining balance basis. Think of it like this. You claim a percentage of whatever left in your UCC pool each year. So the amount you claim gets smaller over time, just like the asset's value. Now, for a great feature, claiming CCA is flexible. In any given year, for any class, you can choose to deduct any amount you want, from zero all the way up to the maximum allowed. If you don't use it all, no problem. The inclement amount stays safely in your UCC pool, ready for you to use in future, more profitable years. Now time for critical rules. These are the anti-avoidance and timing rules you have to know. Pay attention. So rule number one, the available for use rules. You can't claim CCA until the property is actually available for use. It has to be ready for action. When does that happen? It depends on what you bought. For buildings, it's available at the earliest of when you first use it, when construction is substantially complete, when the beginning of the second tax year after you bought it. This is the handy 2-year rolling start rule, or right before you sell it. For everything else, like equipment, it's the earliest of when you first use it to earn income, same 2-year rolling start rule, when it's capable of producing a saleable product, or right before you dispose of it. Rule number 2, the infamous half-year rule. In the year you acquire a property, the CEA claim is actually cut in half. You only get 50% of the normal amount for that year. Important note, this rule applies to the net additions to a class, so your total purchases minus any sales within the same class for the year. Of course, there are exceptions to the half-year rule. This is where it does not apply to class 12 items, which are generally things you can write off 100% anyway. Property that only became available for use because of that 2-year rolling start rule, and certain acquisitions between non-arm's length parties. Rule number 3, the short tax year. If your business has a tax year that's less than 365 days, you have to prorate your CCA claim. The formula is simple. Days in your year divided by 365. If you only operated for 182 days, you'd get half the CCA. Classes, however, are exempt for this rule. See the tax portfolio at para 1.42. Finally, rule number 4, separate classes. Sometimes a single asset has to be its own separate class. This appears for each property you use in a separate business and for specific things like passenger vehicles in the special class 10.1. They can be pooled with your other assets. And this is it. This is the rule book. It might seem a lot, but each rule is there for a reason. Master these mechanics and you'll be a CCA pro.
So you're selling a capital asset? That's fantastic. Great. But what happens in your CCA world? Let's talk about dispositions, recapture, and terminal loss. It's not as scary as it sounds. First, a disposition is just a fancy word. Any transaction where you get proceeds of disposition or POD. That's actually just a sale price. But it could also be insurance money or compensation. Remember our underappreciated capital cost pool? When you sell something, you have to take money out of the pool. The amount you remove is the lesser of your net proceeds from the sale, the POD, or the original capital costs of that specific property. This amount is known as element F, and it's what you deduct from your overall UCC pool. Now, here's where it gets interesting. Meet the recapture of the CCA. This is where the tax man says, hey, you deducted a bit too much CCA in the past, and I need some of that back. And this is what happens when you have a really successful sale. The money you take out of your UCC pool from sales is more money that you put in. The UCC balance can actually go negative. That negative amount, that's actually called recapture. And it's not even a deduction. It's the opposite. You have to include that amount in your income because you're effectively being repaid for some of the CCA you previously claimed. Think of it as CCA you claimed that is now being recaptured back into income. On the flip side, we actually have the terminal loss. This is a really sad story of selling your stuff for a loss. A terminal loss occurs when two things happen at once. The first one is that you have a positive UCC balance left in your pool at the end of the year, and 2, you no longer own any property in that class. The pool is empty of assets, but there's still money left in it. This leftover money represents a loss you haven't yet claimed. Good news, you can deduct this full amount as a terminal loss from your income. It's one last tax benefit for your retired or sold asset. Now, for the special cases. Canada Revenue Agency has specific rules for certain assets. First, we're starting with passenger vehicles. There's a cap on the capital cost you can claim no matter how fancy a car that you bought. Each vehicle gets its own separate class, and here's the kicker. There's actually no recapture and no terminal loss is allowed on disposition. You just stop claiming CCA. Now we're actually talking about land and buildings. This is a really, really big one. You can't just make up a sale price for the building to create a juicy terminal loss while hiding a gain on the actual land. Now, the special rules in subsection 13 bracket 21.1 close bracket, and this governs how you allocate the sale proceeds between the land, which you can actually depreciate, and the building, which you can. This is to prevent creating an artificial terminal loss on the building. Now, the Canada Revenue Agency makes sure that the allocation is always fair and reasonable. And there you have it. That's the actual life cycle of a depreciable asset, from purchase to sale and all the tax twists along the way.
Does it make it hard, like unfair on less sophisticated taxpayers?
The tax system is generally unfair to less sophisticated taxpayers. The different concerns. There's different kinds of property, and the different kinds of property is what leads to different classes of property. At a patent or a license, you might be in one of two classes, in class 14 or class 44. I think the classes are generally intended to follow some principles that have been established under accounting, and then sometimes as well there's deviations to either from the tax policy perspective to increase certain kinds of investments. The government will give accelerated depreciation to encourage certain kinds of investments. You're gonna have to try to find this out if you're owning a property, rental property. So it's the cost of doing business as well.
The second question was about the available for use rule. And we're wondering if in practice, isn't it a major trap for businesses engaged in multi-year projects like construction or complex manufacturing setup?
Is there a happy medium these kinds of taxpayers, first of all, we don't necessarily have to feel sorry for them. These are larger taxpayers that have long, so they're, you know, already from the outset they're more sophisticated, and they know this stuff. So they might be trying to game it. It's an appropriate question, particularly in maybe there's room for some reform to encourage, and we'll see tomorrow what the budget comes up with. If you wanted to reform some aspects or create new classes to increase, for example, residential property availability to address the housing crisis. The difficulty with the housing crisis is that even if you do something today, it takes several months and years for it to make an impact. So it's you know, there are no magical fixes in terms of the best kinds of fixes are long-term good policy, including urban development and you know, densification and these kinds of things that are not necessarily easy to achieve in the CCA regime, but it can operate, I guess, indirectly as a disincentive. But then careful what you ask for. These are at-risk businesses, so you know, do we want to be in a situation where a deduction is made available to, you know, a construction project, and yet it doesn't see it to the end.
Classes and new classes, how do you know how often are, for example, obsolete classes just like let go off, and how often do they create new classes? Is it like a more rigid kind of regulation, or no?
Example of a new class being created in recent history was when eligible capital was eliminated and class 14.1 was created. So that has to do, you know, primarily with goodwill. So if you're buying, if a company is buying, a company would be buying another company, and there's a gap between the book value of the assets and the price that's paid, that's typically goes to goodwill. And so you paid good money for something that on its books is worth less than what you're paying. So that's an example of doing away with an older system, eligible capital, that was a bit clunky and had a different way of doing things than CCA.
This gray area around cryptocurrency and intangible assets, like, is it dangerous? Are we failing to like adapt to the modern economic growth?
Well, trademarks, patents, and that are easier to understand because we've had more experience with them, but it's more difficult with cryptocurrency because we're not actually sure what it is. Yeah, is it a contractual right? I mean, rights under the Income Tax Act is a form of property. Property is just a bundle of rights. So if it's Bitcoin, for example, you know, we think there's a right there. You know, it's different than a deposit in the bank. It's not a bank typically. You can, you know, if you're trading in a Bitcoin ETF, then that looks and smells more like an investment, and that's probably on income, probably on capital account. If you're trading in the ETF, it might be on income account. So you need to think about these things. If you're buying Bitcoin, you have to think about your cost. If your cost is in US dollars, typically Bitcoin is quoted in US dollars, then you might, from a Canadian perspective, you have foreign exchange gain or loss based on that Bitcoin. Guidance out there is that this is really on a barter basis. You're bartering Bitcoin in exchange for stuff, and so then you have to value the Bitcoin at some level, and there may be exchange rate. It is complicated. And then keep an eye on the budget, because that's going to come down tomorrow, and that this is the time of year when tax issues tend to change.